Most traders think the breakthrough will come from a new indicator or a secret entry trick, but the truth is simpler and tougher. With a $100 account, you cannot afford noise, you cannot afford drama, and you absolutely cannot afford a mindset built on luck. What you can afford is discipline, patience, detachment, and the willingness to adapt. This video is a training session, not a highlight reel. I will show you how small capital becomes a functional engine by turning psychology into daily behaviors you can measure. You will get the exact rituals I use and the math that proves why they work, all built for people who have more grit than money. If you can follow rules when the stakes feel small, you will be able to follow them when the size grows. That is how real compounding starts. I have coached traders who came in chasing fireworks and left with boring consistency, and their equity curves thank them. I have also blown up in the past, and the lesson was clear. Markets punish impulse and reward preparation. I learned to think in sequences instead of single trades, to wait for quality instead of activity, to accept a loss before I place the order, and to change my playbook when conditions change. None of that requires talent. It requires a checklist and the courage to use it. Stay with me and you will build a simple, repeatable system around 4 psychological engines. By the end, you will know what to do today, this week, and this month. No promises of easy money, only a process that makes a small account work and keeps you in the game long enough to win. Compounding discipline starts with a simple truth that ego dislikes. Small gains are not small when they repeat. With a $100 account, the path that survives is quiet and methodical. You choose a fixed risk per trade that your nerves can handle. You define your stop before you imagine the reward. You let repetition and probability do the heavy lifting while you focus on clean execution. You are not chasing a jackpot. You are building a machine that pays for precision. Set your risk budget before the session. Imagine you choose 2% risk per trade and a maximum of 4% risk for the day. 2 losses in one day then ends the session by rule. There is no debate because the rule exists before the first candle. On a $100 account, 2% equals $2 of risk. If the distance from entry to stop is 20 cents, the correct position size is 10 units because 10 times 20 cents equals $2. The formula turns a chart idea into a controlled dollar risk and keeps the mind honest when emotion rises. Pick one setup and make it painfully clear. A basic trend with a pullback into structure and a clean rejection is enough. Your choice can be different, but keep it objective and visible on the chart. When rules are fuzzy, the mind bends them to justify action. When rules are clear, the trade either exists or it does not, and most of the time, it does not. A small account cannot survive forced activity. It thrives on selective action and clean passes that preserve capital for the next real signal. Measure progress in sequences rather than single trades. 1 win that follows rules is nice. 10 wins that follow rules are powerful. 1 month of journaled rule-based execution is where compounding truly begins. The compounding does not only happen in the balance. It happens in your skill. Each time you size by formula, enter on a valid trigger, and obey the stop, you strengthen a reflex. Soon, the behavior happens faster and with less mental noise. Compounding skill always comes before compounding equity. See the math with modest numbers. Imagine your average win is 1.5 times your average loss, and your win rate over a large sample is 45%. With 2% risk per trade, the edge is positive because the wins are larger than the losses and they arrive often enough to push the series upward. You are not trying to be perfect. You are trying to be consistent with small edges that add up across many decisions. If you take 20 trades in a month and stop trading when your daily risk cap is hit, even a modest edge will lift the account across time. Refuse variable risk based on mood. Size must come from stop distance and the fixed risk number, not from confidence. Confidence is a poor risk manager. Distance to stop is a good one. When you shrink the stop distance, you do not increase risk. You increase size by the same formula and accept that tighter stops will be hit more often. When you widen the stop because the level that kills the trade is further away, you keep risk per trade the same by reducing size. Build a daily routine that is almost boring. Before the session, you scan a short list of instruments you understand. You mark levels, note the trend, define invalidation, and write your risk number. During the session, you wait for a clean trigger and you do not anticipate. You enter only when criteria align. You set the stop and the first target. If management is part of your plan, use a fixed rule such as move the stop to break even only after price reaches a clear structure level. Rules turn a chaotic screen into a series of small decisions you can execute without drama. After the session, you journal 3 checks in plain language. Did I follow the entry rules? Did I size by formula? Did I obey the stop and the target? Add a screenshot and one honest note about anything you felt in real time, because feelings are data. Do not grade the day by profit. Grade it by obedience to process. Over weeks, the journal reveals patterns that cost you money. You may cut winners early or add to losers to avoid taking the stop. Once seen, these loops can be fixed with simple constraints like hiding the unrealized profit and loss or stepping away after entry with an alert. Add one micro-ritual before any order. Speak the risk in dollars and the exact reason the trade is invalid out loud. If you cannot say it in one clear sentence, the trade is not ready. This step lowers adrenaline and raises accountability. Boredom is not the enemy. Boredom is the tax you pay to harvest compounding. On slow days, you win by following the checklist and closing the platform on time. On busy days, you win by refusing to increase size without permission from your plan. Over time, the balance reflects your choices. The curve rises not because of any hero trade, but because 100 small correct actions stack in your favor. That is compounding discipline in practice, and it is the base that supports every other improvement you will make. Strategic patience is the ability to wait without damaging your account or your mindset. It looks quiet from the outside, yet it is one of the most active skills in trading. You choose to do nothing until the conditions you defined appear on the chart. You pass when a setup is almost good. You end the session when limits are hit, even if a new candle tempts you. Each choice protects capital and attention, and that is the job. Start by defining what a valid setup must include so waiting has a clear target. Write the trend filter you trust, the level that matters, the trigger that confirms, and the invalidation that kills the idea. For example, you might require price above your trend filter, a pullback into a tested level, a rejection wick at that level, and a break of the trigger candle high to enter. Your rules can be different, but they must be specific and visible. When you know exactly what must be present, you can say no to everything else without drama. Reduce noise so patience is easier. Close extra symbols and watch a short list you understand. Hide the profit and loss columns so you are not pushed by every tick. Only watch the time frames your plan uses and set alerts at key levels so you do not stare at candles. If your mind starts to chase, stand up for 60 seconds, breathe, and return with your checklist in view. Patience is not a mood that arrives by chance. It is engineered with limits, boundaries, and small rituals that interrupt impulse. Decide in advance what a no-trade day looks like. If the market opens in a tight range near major news, your edge may be thin. If the daily range shrinks and your method needs movement, you step back. A day without trades can be a win because it preserves capital and attention for a better day. When you log a zero trade day, write why you stood aside and how that decision fits your plan. Over a month, you will see that avoided trades contribute almost as much as winners because they erase boredom losses. Control frequency with a hard cap. Set a maximum of 2 trades per day or 1 per session. Require a full reset after a loss, which means no immediate re-entry and at least 3 fresh candles before you can scan again. Take a short break after a win to prevent euphoria from pushing a low-quality follow-up. These gates turn patience into rules rather than feelings and keep the day from dissolving into a blur of low-probability attempts. Waiting also applies inside the trade. After you enter, the urge to manage too early can be strong. Decide before the session when you will move the stop to break even. Decide what structure must be reached before you scale out. Decide whether you will allow partial profits or hold for a full target. Enforce those decisions with alerts so you are not clicking out of fear. A trade managed with patience has a chance to pay the expected reward. A trade managed by nerves rarely reaches its potential. Use the predator in tall grass image to check yourself. A lion does not sprint at shadows. It blends into the grass, studies the herd, and waits for a clean angle. When the right moment appears, it commits, then returns to stillness. Your job is the same. Blend into the background, watch levels, and protect energy. When the exact trigger appears, you act once with size set by the formula. Then you let the plan unfold. Between trades, you return to stillness instead of hunting for excuses to click. Drawdowns test patience the most. After 2 losses, the screen whispers ideas that are not really there. This is where a daily loss limit and a session stop save you. When the line is hit, close the platform and decompress. Make a short note about where your attention drifted. If a pattern keeps appearing during drawdowns, like taking a second-tier setup to make the day back, write a 1-sentence rule that blocks it next time. The goal is not to avoid all pain. The goal is to keep pain inside a boundary you can survive. Protect your attention like it is capital. Sleep matters, nutrition matters, and hydration matters. If you are tired or agitated, reduce risk or skip the session. Strategic patience includes the humility to respect your current state. A tired trader sees ghosts on the chart. A calm trader sees structure. Build a routine that gives patience a frame. Before the open, you review your plan, your levels, and your risk for the day. You write the conditions that must be present for a trade and the conditions that force you to step aside, such as a news release or a messy middle with overlapping candles. During the session, you keep the screen simple and act only when the plan lights up. After the session, you review by process rather than profit. Ask if you waited for criteria. Ask if you sized by formula, and ask if you obeyed the stop and the target. If you broke patience at any point, write the moment and add 1 constraint that would have stopped that move. Over time, those constraints form a barrier between you and your worst habits. Use small experiments to practice. For 1 week, allow only 1 trade per day. For another week, allow trading only during the most active hour for your instrument. You will feel pressure in the quiet minutes. That pressure is training. Learn to feel it and not act. Give patience measurable targets so you know you are improving. Track the percentage of days where you took only setups that met all rules. Track the number of planned 0 trade days. Track how often you moved the stop before your rule allowed it. Pick 1 metric each week to improve by a small amount. Improvement comes from proof rather than hope. When your waiting behavior gets tighter, results follow, because patience keeps risk small and lets winners breathe. Strategic patience is not passive. It is the choice to conserve time, capital, and willpower for the rare moments that deserve action. When you let mediocre trades pass, you create room for the trade that starts clean, moves clean, and pays according to plan. Repeat that choice across weeks, and a small account survives the grind and grows with dignity. Wait for quality, pass on noise, and when the plan lights up, act once and be still again. Stay patient. Outcome detachment keeps judgment clear when the market pulls you toward hope or fear. You separate what you do from what any single trade returns. A win is not proof of excellence, and a loss is not proof of failure. Proof lives in whether you followed the plan you wrote when you were calm. This frame removes the need to be right and replaces it with the duty to be precise. Begin with pre-accepted risk. Before you touch the keyboard, speak the dollar amount you are ready to pay to test your idea. Link that number to your stop and your position size so there is no wiggle room. When the cost is already paid in your head, a stop is a routine expense. If the level breaks, you exit without delay. The market does not owe you a refund. Log the cost and move on. Make your thesis binary. State what makes the idea valid and what makes it invalid in 1 sentence each. Price above structure with rising momentum is valid. Price back inside the range with fading momentum is invalid. When both sentences are clear, test them against the live chart like switches. If the valid switch is on, act. If the invalid switch flips, exit. There is no debate because the sentences are simple and visible. Shrink the size of each decision until your heart rate is boring. Detachment is easier when a single outcome cannot hurt you. If 2% risk feels heavy, use 1%. If 1% still grips your chest, go to 0.5% for 2 weeks. Scale only when behavior is steady. The goal is not to be brave. The goal is to be consistent. Use set and forget with intention. If your edge needs the position to breathe, stop babysitting the chart. Place the order, place the stop, place the target or alerts, then step away for a preset block of time. Your job is not to micromanage each tick. If you must watch, watch only price at the levels that matter. Hide the unrealized profit and loss if it pushes early decisions. Run a short pre-mortem and a short debrief. Before entry, imagine failure and name the most likely reason. If the reason is that you would ignore a rule, do not take the trade. After exit, ask 3 questions. Did I follow entry criteria? Did I size by formula? Did I obey the stop and the target? Write 1 sentence for each answer. Keep notes blunt. This is a scorecard for behavior. Create neutral language. Replace I won and I lost with my plan won and my plan lost. Replace I am right with my conditions are present. My invalidation is hit. These phrases keep identity out of the chart. When identity fades, detachment grows. You can cut a loss without cutting your self-worth. Design a ritual for fast exits. The moment price tags your line, tap the exit hotkey and say exit first, think later. Then step away for 60 seconds before any other decision. This gap blocks the revenge click that turns a normal loss into a spiral. If you need to move, screenshot the chart and mark the level that broke. Motion turned into a record creates closure. Let winners work. The urge to feel safe pushes many traders to take profit at the first flash of green. If your plan calls for partials, set them in advance. If your plan calls for full targets, do not shrink them mid-trade because a candle looks scary. Fear shrinks winners and feeds the myth that perfection is required. Process asks for alignment between rule and action. Train focus like a muscle. Use a timer for blocks where you observe only the signal time frame and the key level. Put your phone in another room. Close chat apps. Sip water and breathe. When your mind drifts into what-if thoughts, name the thought and return to the level. You are teaching your brain that not every impulse earns a click. Respect your state. If you slept badly, if you are angry, if you feel the pull to make back a loss, cut size to a token risk or skip the session. Detachment is not cold. It is compassionate toward the human who trades. Give yourself conditions that make good behavior likely. Protect energy so rules can operate. Measure what matters. Track process adherence as a percentage. Track average risk per trade. Track the time between exit and next decision. Track how often you moved a stop before your rule allowed it. These numbers mirror behavior. When they improve, profits often follow as a side effect. When they slip, tighten your environment and your rituals before you chase a new setup.
You are building a craft. Crafts grow through repetition under honest feedback. Outcome detachment is not a trick to feel nothing. It is a way to feel less chaos and more control. You will still care about results, but you will care in the right order. Process first, risk next, outcome last. When the order stays intact, a small account stops swinging with every candle and starts moving with the plan. That is how you stay in the game long enough to let probability do its work. Adaptive reinvention keeps your edge alive when the market changes its mood. You cannot force a trend to appear, and you cannot extract smooth momentum from a choppy range, but you can change how you operate. Adaptation is not luck. It is a cycle of small tests, clear notes, and timely adjustments that protect your account as conditions shift. You do not need to predict every turn. You need to notice the character of price and respond with tactics that fit the present moment. When you match method to context, you remove the hidden tax of stubbornness, and you give your edge room to work. Begin with regime awareness. At the start of each session, ask a simple question. Is the tape trending, ranging, or driving fast and snapping back? Trending price builds higher highs and higher lows, or the opposite in a steady staircase. Ranging price rotates between clear boundaries with attempts to break that quickly fail. Drive and snapback shows a long burst that quickly retraces as liquidity thins. Write the answer before you plan a trade. Your entry, your stop, and your target must match the condition you see, or the trade will fight the tape. In a trend, you want continuity tools. In a range, you want mean reversion tools. In drive and snapback, you want fast timing and room for volatility. Naming the regime turns a messy chart into a map you can follow. Create a compact playbook for each condition so you are never guessing.
For trend days, favor pullbacks into obvious structure with a clear continuation trigger, then give the trade room to breathe beyond the noise. For ranges, favor fades at the boundary with quick profit taking near the middle and tight risk sitting just beyond the edge. For drive and snapback conditions, consider the first pullback after the snap as the cleaner entry and expect speed. These lanes prevent mismatches, like breakout tactics inside a sleepy range or slow fading tactics thrown at a strong one-way move. A small account cannot afford mismatches. When the lane and the environment agree, you remove friction. When they disagree, you pay slippage in attention, patience, and capital. Keep the playbook short and visible so that choices become automatic in real time. Scale aggression with clarity. When structure is clean and volatility is steady, allow a normal frequency of trades. When candles overlap and wicks crowd the screen, reduce frequency and target only the most obvious levels. When speed rises, widen the stop to the true invalidation and reduce size so that risk stays constant. Position size must respond to stop distance and never to confidence. Confidence is a story. Stop distance is a fact, and facts are the anchor you need when screens get loud. Run micro-tests before any major change. If you use a single time frame, add a higher time frame for context for 1 week and record whether it kept you out of messy zones. If you usually take 3 trades per day, test 2 trades per day for 5 sessions and measure your process score and your equity swings. If you want to try a new entry trigger, apply it on replay or in a tiny size across a dozen samples. Keep the rest of your plan stable while the test runs so you can attribute results to the change and not to random drift. Write the hypothesis before the test and write the decision after the test. Small scientific loops beat mood-based tinkering, and they preserve capital while you improve your edge. Kill ego daily. Ego wants to keep doing what worked last month because it feels safe, and it wants to push size after a hot streak because it wants to feel important. Neither urge helps. Write 1 sentence at the top of your plan that you will update behavior when data tells you to and not when pride tells you to. Then prove it. When your journal shows that a tactic lost money for 3 weeks, pause it and test an alternative in small size. When a tactic performs, protect it from overuse by keeping frequency limits and by refusing to force it into the wrong regime. Adaptation is humble. It listens to results and it changes course without drama. Finish with a simple rhythm. Observe the condition, choose the matching tactic, execute with size derived from the stop, and review the behavior. Repeat. The rhythm is the metronome of your work. With it, you do not need constant novelty. You need steady alignment between what the market is offering and how you choose to act. Across months, this alignment compounds as reliably as capital does. It turns noisy screens into deliberate work and keeps your edge alive when the market begins to behave differently. This is your 30-day practice loop that connects the 4 engines and turns ideas into muscle. For days 1 through 7, you focus on compounding discipline by running the same routine at the same time each session. Write your fixed risk per trade, sized by the stop distance formula, and take only the single setup you chose. End the day when your daily loss limit is hit and log 3 process checks. Grade the day by rule obedience rather than profit, and record 1 sentence about what felt difficult. For days 8 through 14, you train strategic patience. Set a hard cap of 2 trades per day or less, define the exact conditions that create a valid entry, and log at least 1 planned 0-trade day when criteria never align.
Close extra symbols, hide the profit and loss display, and use alerts at levels so you do not stare at candles. Your win in this block is refusing almost good trades and feeling the pressure to act without moving your mouse. For days 15 through 21, you install outcome detachment. Before entry, speak the dollar risk out loud, state the sentence that invalidates the idea, and use a set and forget window after placement. After exit, answer 3 questions about entry rules, sizing by formula, and stop or target obedience. Replace I won with my plan won and I lost with my plan lost so identity stays off the chart. For days 22 through 28, you practice adaptive reinvention. Start each session by labeling the regime as trend, range, or drive and snap back. Pick the matching lane from your playbook and run 1 micro-test in tiny size, such as using a higher time frame filter or reducing daily trade count. Write the hypothesis before the test and the decision after the test. On day 29, you review the journal and compute 4 numbers. Process adherence as a percentage, average risk per trade, frequency per day, and the number of times you moved a stop early. On day 30, you set the next month goal as 1 sentence, keep what worked, and cut what did not. Then you start again because repetition under calm rules is how a small account becomes steady and useful. Here is your final checkpoint. You do not need more indicators. You need 1 plan you can run today with a small account and the patience to repeat it. Compounding discipline sets your risk, your size, and your routine. Strategic patience filters noise so only true setups survive. Outcome detachment keeps your identity off the chart and keeps exits clean. Adaptive reinvention lets you change lanes when the market changes character. Together, they turn a fragile $100 into a training ground for professional behavior. Start now. Download the planner, copy the example rows, and fill the numbers that fit your instrument and your schedule. Print the checklist, tape it near your screen, and speak your risk before every order. Run the 30-day loop 1 time without skipping a step. Then run it again. In the comments, tell me the single rule you will adopt this week and why it matters to you. If you want feedback, post 1 journal screenshot with your 3 process answers. Keep the work simple. Keep the promises you make to yourself. Let consistency do the heavy lifting.